Okay, Sunil Subramaniam joins us. Sunil, good to have you back on ET Now. Thank you for joining us. Sunil, are we going through that phase of the market where there is universal acceptance that things will look up? But the market is now due for a time-wise and price-wise correction, given that everyone thought that on the corona front we had won the war, on the global front nothing will go wrong and inflation will remain low and liquidity will remain high. Now those assumptions are not reversing, Sunil, but those assumptions are getting challenged.
Yes, but then, Nico, you got to look at it that this is the second wave. What do I mean by that? I mean that there are a lot of learnings from the first wave. A lot of missteps of the first wave will not be repeated in tackling the second wave. So you are already seeing that, how the response is now local as opposed to global in terms of doing a lockdown, let's say, right? Each state is doing on its own at the Second, there's a consciousness of economic impact. I think first time around, we were keen to show the world, and the world was keen to show everybody that they cared for the citizens of the world from a health perspective. And hence, actually said, economy be damned, let's take care of the health. This time, you're seeing a more pragmatic approach. They're trying to protect areas of the economy, at the same time taking care. And the vaccination, they're trying to step up. So I think there's a significant difference between a second wave and the response on the first wave. That's one of the reasons that the markets are not reacting, as you said, to the bad news on the horizon in terms of the second wave or whatever coming through. Similarly, in terms of, you mentioned the other aspect on US inflation and US interest rates. There is this underlying fear that the US is going to hike rates quickly, right? But the fact of the matter is, despite the Fed's dovish statements, despite saying that we'll continue, there is just that element in the market not believing him. And that's the reason there is a little bit of a check and balance. But underlying underfooting, if you say, let's take even a year from now, I normally talk 3 to 5 year perspective, but leave that aside. Let's project yourself a year from now. Are we not confident that we will tackle this second wave, take care of it, and the underlying strength of the economy, which is the economies have gone through a long period of low demand, negative demand, and effectively capex being shut down. So now you're seeing Biden talking about a huge infrastructure spend, India talking about a huge infrastructure spend. So if you give yourself the year as a forward-looking time frame, you will say that I will cover all of these negatives and I'll be on a positive track. Now, as a buyer in the market, right, are you going to then look at the next 1 year, the volatility which may be there? I don't expect it to last 1 year. I think maybe 6 months with the volatility will be there. If you don't use this as a buying opportunity, you will then be again regretting those who redeemed during the post-corona crisis. Today, they are kicking themselves on the foot and saying, oh, I shouldn't have redeemed. I've lost out on 100% gains, which I could have had. So I think that is the next second learning. So this time around, you will not see that panic selling happening when there is volatility. On the contrary, there will be smart buying in. So that's why I believe that this is going to be a phase of news flows will come up and down, Nikunj. You can't prevent that. You can't predict actual unemployment data, actual vaccination progress, actual second waves. But whatever news comes, the correction, the fall will be shallow because there are enough buyers waiting, either those who have redeemed and sitting on cash over the last 1 year, or those who have a outlook which is beyond the next 1 year will step in to buy. I think that explains the way the market is reacting to events.
Have the outflow stopped, Sunil? Something which we were debating yesterday with Nilesh and Bala. At the funds which you manage, have you got more money than what you've sold last month?
We are brought about even Stevens, but there's been something like a 60% drop in our redemptions. So yes, the outflows have significantly reduced. The uptick, because it happens in specific segments of the market. So we are about even Stevens for the month, but industry as a whole, you're seeing has turned positive. So I think that this again is what I was just explaining, Nikunj, that the people who were redeeming were doing so because there was a disconnect between what they saw as the economic activity happening on the ground and the market simply rising as if there is nothing wrong with the economy. That disconnect didn't sit well in the minds of investors, and hence they redeemed, saying, I don't know how this rally is going to last when there is no good economic news. But over the last 2-3 months, you've seen the economic news get better. And that's why, despite the second wave happening in a few states, you're seeing that investors are now beginning to believe, A, there is a feeling that I lost out by redeeming earlier. and so let me put my money in, not repeat my mistake. Second, there is a genuine confidence that the activity level and the economic level, both from a government action, government being sensitive to economic impact of a fresh lockdown, hence micro monitoring and managing that in a way that economic impact is minimized. And second aspect is that people are believing that it's a good time to invest. So I think that from an index perspective, Nikunj, when you're looking at it, the thing is that I see happening is that whatever action in terms of market news action is going to be largely on the large cap and the larger mid cap space. But the economic news coming is going to be more supportive of the smaller and the smaller mid caps and that frame. So you will see a slow change of leadership. So that's why you won't see the indices touching very great highs, but a broader market will show a breadth of response will be much, much better.
Sunil, I know Sundaram is a system-driven company, but there is a change of guard. And historically, we've seen that when a CIO or fund managers, they change, the portfolios change. I've seen that happen in a lot of schemes and a lot of mutual funds houses. Forget about CIO going. It's when a fund manager goes, the new fund manager changes the orientation and portfolio orientation. What will happen to your schemes because of change of guard?
We will gradually reduce our high risk, high reward positions, Nikunj. Let me be honest and admit it. This, while you're talking about the change of leadership at the CIO level, an underlying process shift has been happening at our company over the last 6 to 9 months. You see the nature of the launches we launched. We launched a diversified large cap. We launched a balanced advantage fund. We launched a multi-cap fund over the last 1 or 2 years. So gradually, Sundaram is going to be going more middle of the road from a pure high risk, high reward, high small cap, micro cap, high bets kind of a thing. So independent of this move on change of leadership, there is a change in the construct of the portfolio. I will tell you that our mid-cap fund, for example, when the SEBI reorg happened, was at 95% mid and small cap. That is 70% mid-cap, 25% small cap. Today, it has 15% large caps in the mid-cap fund, right? Similarly, if you see our multi-cap. So everywhere we are moving to a more less high-risk, high-reward positioning and trying to get into a closer to the benchmark. You know, the deviations from the benchmark are something through a process we are managing to control, and you will see that effect in our funds. So the volatility of our fund performance will come down, and I think the returns will be more closely in line with a broader market as opposed to the old Sundaram, right? Which was very high risk, which is when the markets and the economy was booming, we were like giving 100% return a year, but when it dropped, naturally those positions hurt us. So this conscious shift has already started happening over the last 6 to 9 months. That will get strengthened, and you will see portfolios altering because of that. So I agree with your point that people, you may associate, oh, CIO left, so the portfolio changed. But if you track our company over the last few months and see that the trend change is already happening, and that will get strengthened going forward.
Okay. So, Sunil, how are you looking at the portfolio mix now, given the ever-evolving situation?
You know, one, I just spoke about the way the processes are changing. The second is that, you know, we have announced the principal acquisition. Now, one of the key things is our portfolio had about 58 to 60% mid and small caps overall as an AMC. Principal, which is about a quarter of our size, has a 75% large and mid cap portfolio. So we expect CCI has already approved this a couple of days ago. SEBI approval is under progress, so maybe it may take a few months. But as and when that approval comes and the merger happens, automatically you will see that we'll become much more broad-based. So the proportion of mid and small caps in our portfolio will come down sub 50% as a natural course. Plus, as I mentioned, our portfolio mix itself, we are trying to align ourselves closer to the broader market indices. And so if you see, even a BSE 500 index has 80% large caps. So if I'm running a multi-cap, flexi-cap portfolio, I can't ignore it. If that is BSE 500 or NSE 500 is my benchmark, I can't ignore the fact that's a large cap laden, right? So you will see gradually that positioning going to what I would call a middle of the road, right? And not so much of the extremes. So that process will translate into sectoral positionings also. So we will try and not avoid. For example, I will tell you, a year and a half ago, we were underweight pharma to the extent we were zero. And when the corona crisis came and post that pharma rallied, We then rejigged our portfolios, but obviously we were late on the curve. Those who already held pharma, obviously. So such kind of a positioning where we were zero pharma some time ago, right, will never repeat in the future. So we will not be zero or strongly underweight or overweight any sector. We will have a conscious thought of the benchmark, what sectors are there, the dynamics of the market as they are moving, and we will try and operate like a horse operates with blinkers. We will operate within specified policy parameters in terms of how much overweight, underweight to the benchmarks and to the sector weights. So the question I had was in terms of sectors. So you will see us getting a more. So if I say I'm underweight pharma to you today, I will say that I am like say 2-3% of the benchmark weight of pharma and not 0%. So that's a significant change which is been happening over a period of time and will get strengthened over the next few weeks. So you will see that Sundaram, which is much more closer to the middle of the risk reward curve in terms of our position.
Understood. I'm just taking a look at some of the recent buys. Sunil, Happiest Minds, IGL, Home First, Page. It's a mixed selection coming in. I mean, I completely take the rationale with which you're going, but I'm also noticing, a really kind of unique mix of names there from the broader markets as well that are part of the basket. What's the kind of return, potential that you're seeing, whether on, even in terms of an average going forward for the year, because there must be, of course, some of these processes that you've applied while picking these stocks. So there must be some expectation you have on performance going forward.
Absolutely. So you mentioned some of those names. Now you got to remember that we are the only fund house in the country who has a services fund. So naturally, our ability to buy those, internet-based, high-tech, fintech, those kind of positions is much better because I have a 1,300 crore services fund which is dedicated to these services. So my ability to buy these comes from that fund being there in the market with money. That's number one. Number two is the fact is that when you look at the return potential, right? So if I would say that a safety fast portfolio, right, like IT or whatever, we would expect to give high single-digit returns, right? And whereas our high risk, high reward component would give about 25 to 30% returns. Now, in the old Sundaram, I would have been very bullish. I'd have stocked up my portfolio to a greater with this high risk, high reward, and hence a return potential from the rest of the year, I would expect an 18 to 20%. But being closer to the benchmark middle of the road, the safety components being higher, I would say that something close to 2 to 3% over the nominal GDP of the country as it pans out. So if you look at, they're talking about a GDP of about 10 and about 4% to 5% inflation. If you look at, so 15. So I would argue that we would be north of that in terms of a broader portfolio returns, especially because of our new positioning.
Sunil, if I just look at how the indexes have performed just this month as well as this year, I think the market messaging seems very clear that the tilt is in favor of the mid and small caps. While the Nifty has risen about 1.25% this month, this year it's up 6.5% nearly. The mid cap index in the same time has risen about 3.5% roughly this month, with a 17.4% move coming in year to date. Small caps even further, a 5% move this month and a 20% move year to date. Would you say that for at least the next foreseeable future, it's time to bet on mid and small caps, although selectively?
No, look at it this way. I would say is that while the facts, as you say, come through that way, it is the reason is that it is a sectoral performance which drives the cap curve performance. See, when a fund manager, whether he's an FPI fund manager, an insurance fund manager, a mutual fund manager, right? When he does, they always approach what is called an EIC framework. Study the economy first, then the industrial sectors within it, then choose the companies. So when a fund manager goes out and buys, he's got the sector view in his mind. Now, the reason mid and small caps have taken the lead is because there's a sectoral shift from safety to risk in the market. So whether you're buying large cap funds or mid and small cap, the fund managers who allocate to this cyclical, the growth sectors, right, will deliver better returns. So from an investor's perspective, rather than go and put everything into mid and small cap they're seeing, I would say choose the funds. Even a large cap fund with the right sectoral mix can deliver very good returns compared to the mid and small cap. So I would say that you're actually, this move that's happening is excellent, because over the last year, this didn't happen because FPIs were dominating the market. And hence, that's why you see 74% of fund managers did not beat the indices, because they run broader portfolios. But now I see that this next 6 months, I would call it the return of the alpha. Right? I would see fund managers, because they go research-based and sector-based in their approach, would pick those sectors which would deliver better returns, and that then will translate into large-cap funds, mid-cap funds, small-cap funds. So from an investor perspective, I would say stick to the flexi-cap, to the multi-cap kind of a category, where the fund manager can do the right sectoral mix and deliver the best return. It's not necessarily that you blindly say, oh, mid and small cap ran up, so I'll put my money in mid and small cap. That's not the true story. It's the sectors driving the cap curve, which you got to track. And I would say, from an investor perspective, leave it to the fund managers through a flexi cap, multi cap. They will do the right sectoral allocation and deliver the best returns.
Sunil, the construct of the economy is such that small cap companies are losing. They may have got lucky in last 2 quarters because inflation and little bit of pent-up demand has come back, but this corona crisis has taught us that big is getting bigger, small is getting marginalized, and that's applicable even in the listed space, the non-listed space, SME level and MSME level. So what if the basic construct of the economy is towards large and mega caps? Why do you think small and mid-cap investing will work?
Nikunj, it's a very good point that you raised. And what I'd like to say is, you mentioned this briefly in your question itself. The smallest of the small cap companies is a large cap within the overall Indian economic universe, right? You mentioned MSMEs, SMEs, none of those are listed, right? So while you look at a BSE 500, NSE 500 and say in these 500 companies, these are the bottom end, actually in a lot of places where they operate, they are the dadas of their space, because there's a huge amount of MSMEs and what is the reason for this? The reason for this is that the lockdown come the corona crisis has given a strong push to the formalization and digitalization of the economy, something that Demon failed to do. Demon plus just GST failed to do. The lockdown and the crisis has forced it. So this process of formalization is what you're seeing. So I would say, yes, the very large caps are obviously poised to gain greater market share, but don't discount the small caps, because they can gain market share from the MSMEs and the much smaller places. And second aspect, Nikunj, is that a company which is getting listed means that he is getting a proportion of equity capital from investors to finance, whereas your typical SME, MSME has only the promoter's capital contribution. The rest is heavily dependent on bank funding, on microfinance funding, on everything else. So their cost of funds are significantly larger, and they don't have the cushion of a debt equity ratio, which is healthy because of equity. Whereas the smallest small cap company, because he's tapping the capital market, and today you have seen the number of funds which are doing FPOs and IPOs, is that you are getting to spread the equity ownership over a large number of people and give that stability to the balance sheet. So what happens is that interest being a fixed cost, right? The more equity you have, the less volatile your performance. So I would argue that small caps, in fact, are present in lots of sectors which are growth sectors where large caps are just not present. So that's where you will see that small and mid caps will show leadership, because in large caps, how do you define it? Top 50, top 100, you are still limited to a certain set of the sector.
Right. Well, it's a great point, Sunil. It's a great point. I need to conclude today's lovely interaction just to tell our viewers that don't go by market cap. What Sunil and we are trying to flag off is that now look at a battery space, Exide and Amara Raja. Now both the battery companies put together, that's not even a $25 billion industry. Now there are a lot of large caps. Just because you have a $10 billion market cap does not make you a large cap. And just because you are a $5 billion company, that does not make you a dominant player in that space. And that is what I think Sunil is trying to say, that look at pocket niches where you will be able to pick up spots.